Welcome back to the Deep Dive. We are covering something today that I think a lot of people feel intuitively,
hmm
but maybe haven't seen the hard data for until now.
Yeah.
It's this idea that the ground beneath the tech world has just, completely shifted.
Completely. Yeah.
If you rewind just a few years, let's say 2020, maybe 2021, the
Yeah.
entire semiconductor universe, and really the stock market that followed it,
hmm
it all revolved around the smartphone.
It was the heartbeat of the industry. You had the predictable September launches, the supply chain ramps up in the summer. I mean, you could basically set your watch by the mobile cycle.
Right. And today we're looking at a report that essentially takes that calendar, shreds it, and just tosses it out the window.
Uh-huh.
We're unpacking the Q4 2025 earnings from Teradyne, ticker symbol TER. They released the numbers yesterday, February 2nd.
And if you want to know if this AI hardware boom is actually for real or if it's just, a sugar high,
This is the company you have to look at.
this is the ultimate litmus test.
Yeah.
For anyone not familiar, Teradyne makes what's called automatic test equipment, or AEE.
Right.
These are these massive, almost room-sized machines that test the chips, the processors, the memory, everything, before they ever get put into a server or a phone.
So if a chipmaker builds it, Teradyne has to basically grade it, give it pass-fail.
Basically, they're the gatekeepers. And what this Q4 report tells us is that the gate is currently being stormed.
Okay, let's get into the headline numbers, because they seemed shockingly high for a company that's usually pretty steady.
They were.
Teradyne reported revenue of $1.08 billion for the quarter.
Mhm.
My notes say they beat expectations by over $112 million.
Yeah.
I mean, that seems like a massive miss by the analysts.
It is a massive beat, especially in this kind of industrial sector where things are usually modeled out to the decimal point.
Sure.
But the earnings per share, the EPS, that's where the gap was really wide. They came in at $1.80.
And the consensus was what, like 136?
$1.36, yeah. So
Yeah.
they beat by 44 cents per share.
That explains why the stock popped, 13% in after-hours trading? But look, companies beat earnings all the time. Is this just good execution, or is there something, structural happening here?
It's absolutely structural. This report is pretty much the obituary for the mobile-first era of semiconductors, and I think the coronation of the compute-first era.
Mhm.
The money is just not coming from where it used to.
Okay, let's dig into that compute-first idea. Because usually when I hear compute, I think of my laptop. But that's not really what we're talking about here.
No, not at all. In this context, compute is basically shorthand for the data center, the huge AI clusters.
Okay.
And if you look at the internal breakdown of Teradyne's revenue, there's one single metric that explains the whole quarter. In Q3 of 2025, AI-driven demand was about 40 to 50% of their revenue.
Which is already pretty dominant.
It is. But in Q4, it jumped to over 60%.
60.
And Greg Smith, the CEO, he didn't stop there. He said that looking ahead to this quarter, Q1 2026, they expect AI to drive upwards of 70% of their sales.
Wow. That is moving incredibly fast. So in just 6 months, they've gone from half their business being AI to nearly 3/4.
Yeah.
It makes the smartphone business look like a legacy act.
And the growth rates back that up. Their compute business grew 90% year over year. Meanwhile, mobile is just kind of there. It's not dead, but it has been totally eclipsed.
I want to pause on the why, though. Because logically, you think, okay, companies are buying more chips, so they need to buy more testers. Simple math.
Mm-hmm.
But I was reading through the transcript, and they kept talking about complexity and verticalization.
Yeah.
It sounds like testing an AI chip is just a fundamentally different job.
It's a completely different beast. And this is where we have to talk about a concept they brought up called tokens per watt.
Tokens per watt.
Yeah.
Okay, that sounds like a metric from an arcade game.
It does, doesn't it? But it's actually the holy grail for the hyperscalers. The Microsofts, the Googles, the Metas of the world. An AI model generates tokens, which are just chunks of data or text. These companies are burning billions of dollars on electricity, so they need to know with extreme precision how much power it costs to generate one of those tokens.
So it's an efficiency metric.
Yeah.
But why does that make the testing harder? Can't you just plug the chip in and see how much juice it draws from the wall?
If only it were that simple. You have to remember, these chips are being pushed to their absolute physical limits. To test tokens per watt accurately, Teradyne's machines have to simulate a full load environment.
Right.
They have to manage this massive heat output, supply incredibly precise voltage, we're talking millivolt accuracy, and measure the data throughput all at the exact same millisecond.
So it's not just a pass-fail test anymore. It's more like a...
It's a grading curve, exactly. They are grading the quality of the silicon. A chip that performs at 99% efficiency might go into a premium server rack.
And one at 95% might get downgraded or rejected entirely?
Precisely. And because the chips are verticalized, meaning they stack memory, power management, logic, all in one package, the tester has to talk to all those different parts at the same time.
That makes a lot of sense.
Yeah.
If you're building a Ferrari engine, you don't test it with a tire pressure gauge.
Right.
You need a wind tunnel and a dyno. And Teradyne sells the wind tunnel.
That's a great analogy. And because the engines are getting bigger and hotter, the wind tunnels have to get a lot more expensive, which, helps drive Teradyne's margins up.
Okay, so the gear's getting fancier.
Oh.
But there was another weird anomaly in this report that I want to unpack. We touched on the mobile cycle earlier. Strong summer, weak winter.
Mm-hmm.
Usually Q4 is a quiet time for these guys. It's the holiday hangover.
Historically, yes. You build the iPhones in Q3, you sell them in Q4, so the factories stop buying new equipment in Q4.
But Teradyne just had their biggest quarter of the year in Q4. And looking at their guidance, they're saying Q1 of 2026 is going to be even bigger.
A record, yeah.
Revenue between $1.15 billion and $1.25 billion. That's a record.
Michelle Turner, the CFO, she actually called this the inverse year. She basically said 2026 is going to be the mirror image of a normal year.
The inverse year. So what's driving that flip? Why is everyone suddenly buying in the winter?
It comes down to who is actually pulling the strings now. We have to distinguish between two types of customers here, the specifying customer and the purchasing customer.
Okay, hold on. I saw that in the notes. Specifying versus purchasing. It sounds a little like corporate jargon to me. What's the real difference?
It is a bit, but it's really about a power dynamic. A specifying customer is the company designing the chip. Think NVIDIA, Apple, AMD. They don't usually own the factory.
Right.
But they tell the factory, if you want our business, if you want to build our chip, you must use this specific Teradyne machine to test it.
So they dictate the entire tool set.
Correct. The purchasing customer is the factory itself, usually a foundry like TSMC or an OSAT. They're the ones actually writing the check to Teradyne.
So wait, if I'm the factory, I'm paying hundreds of billions of dollars, but I don't even get to pick the machine. That seems frustrating.
It's the price of admission. If NVIDIA says jump, the factory asks, how high?
And right now, the specifying customers, the big AI designers, are screaming for capacity.
They're telling their factories to buy everything Teradyne can build right now, regardless of what month it is.
Okay, so that explains the Q4 and Q1 boom. Basically panic buying, or at least rush buying.
It's an arms race. And that leads to this issue they call lumpiness. When you have just 2 or 3 massive companies dictating the schedule, you don't get a smooth demand curve. You get a tsunami, and then the tide goes out.
And the report mentioned that specifically, didn't it, this customer concentration?
They did. In 2025, they had 2 specifying customers and 1 purchasing customer that each accounted for more than 10% of total revenue.
Wow.
That is a lot of eggs in very, very few baskets.
So the risk here is that once these giants have bought what they need for this round, the phone just stops ringing.
That is the air pocket risk. Management was very transparent about it, maybe surprisingly so. They said they have limited visibility into the second half of 2026.
So they know the first half is sold out. It's a rocket ship.
Totally sold out. But July through December, it's a giant question mark.
Which brings us back to that inverse year idea.
Yeah.
They expect 60% of their 2026 sales to happen in the first 6 months. That implies a pretty steep drop-off in the second half.
It implies a digestion period. These companies buy the machines, then they have to install them, calibrate them, and ramp up production. They stop buying while they get the new gear up and running.
So if you're an investor, you have to be comfortable with that. Silence.
You do. It's a feast, then famine, then feast again model. But that's just the nature of the semiconductor beast right now.
Now, we spent a lot of time on the chips themselves, the silicon brain, but Teradyne is making some interesting moves to expand beyond just the chip.
Mm-hmm.
There was an announcement tucked into the call about a joint venture with a company called Multilane.
This is a really important piece of the puzzle that I think often gets overlooked. We talk about the AI chip all day long, but we forget that these chips have to talk to each other. An AI cluster is thousands of chips linked together.
It's the plumbing, so to speak.
Exactly. The cables, the optical interconnects, the transceivers, that is the nervous system of the data center. And right now, that plumbing is a major point of failure. You
Ah,
can have the fastest GPU in the world, but if the cable connecting it to the next rack is faulty, the whole system just slows down.
and multi-lane. They test that stuff.
They are specialists in it. High-speed I/O, data center interconnects. By forming this JV, Teradyne is basically saying, we aren't just testing the wafer anymore. We are going to test the signal all the way from the chip to the cable plugging into the server rack.
They called it wafer to data center.
Right. It's a very smart strategic move because it captures more value from the same customer. If the hyperscalers are obsessed with efficiency, they need to know the cables are perfect too.
It's about owning the entire quality control chain. Okay, that makes sense. But speaking of things that usually get ignored,
Yeah.
we have to talk about robotics.
Oh, yeah.
For the last couple of years, every time we looked at Teradyne, the robotics division in Universal Robots and Mirror, it felt like a drag on the earnings. It was shrinking.
It was bleeding money. The industrial recession just hit them so hard. But this Q4 report showed a genuine pulse. Revenue was $89 million.
Up 19% sequentially.
Right, that's 3/4 of growth in a row.
But there was this one specific detail about who is buying these robots that caught my eye. They mentioned a large e-commerce customer.
Yes. They didn't name names, but when you hear large e-commerce and robotics, you can make some educated guesses.
Logistics, warehousing.
Exactly. This one customer accounted for more than 5% of the entire robotics revenue in the quarter.
Just one customer. That seems really significant for a division that sells thousands of these small robots.
It's huge. And the guidance was even more interesting. They expect revenue from this specific customer to triple between 2025 and 2026.
Why now? I mean, warehouses have been around forever. Why this sudden surge in buying robots in 2026?
It's likely a combination of labor shortages and just the need for speed. We're seeing a renewed push for automation logistics to handle next day, even same day, delivery volumes.
So if this one big customer is ramping up, it suggests the whole logistics sector is finally ready to spend money again.
It seems that way. And for Teradyne, the goal is pretty simple. Just stop losing money on it.
Right.
They are targeting break-even for the robotics group in 2026. If they can hit that, it turns from a headwind into a tailwind. And it provides a nice little cushion of diversification if the chip market hits that air pocket we talked about.
Okay, let's zoom way out. Because of all this weirdness, the lumpy AI demand, the inverse seasonality Teradyne did something with their long-term guidance that I found really fascinating. Usually a company tells you, in 2027, we will earn X dollars. A specific target for a specific year. Teradyne didn't do that.
No, they refused to put a date on it. They introduced what they're calling an evergreen model.
Explain that to me.
Right.
Because to a cynic, it sounds like they're just dodging the question. We'll hit the target eventually.
I can see why it sounds that way. I really can. But in an industry this cyclical, it's actually, I think, a more honest way to forecast. Instead of anchoring to a calendar year, they anchored to a market size.
Okay.
They said, look, we don't know exactly which year the total addressable market for test equipment will hit $12 to $14 billion. It might be 2027, might be 2028. But when that happens, here's what our financials will look like.
So it's an if X then Y model, regardless of when X actually happens.
Precisely. And the Y is pretty attractive. In that scenario, they're targeting $6 billion in revenue.
$6 billion. They just did about, what, $3.2 billion in 2025.
Right. So they're mapping out a path to nearly double the size of the company.
And what does that do to the bottom line? To earnings?
They are targeting earnings per share of $9.50 to $11. Considering they just posted $3.96 for the full year 2025, that is a massive, massive jump in profitability.
And they expect gross margins to climb to around 60%. That implies they aren't just riding the wave, but that they expect to get more profitable as they grow. How do they actually achieve that? Is it just selling more expensive machines?
That's part of it, but they also have to win market share. And this is where they were surprisingly humble. In the compute space, the AI stuff, they admitted they're coming from a lower market share position compared to their main competitor.
So they're the underdog in compute.
Historically, yes. Their competitor has been very strong in high-end logic, but Teradyne claims they are winning the new battles. They are targeting around 50% share in what they call VIP compute.
VIP compute, another acronym.
It stands for Vertically Integrated Producer. It's basically a fancy term for the big tech companies designing their own chips, the Googles and Amazons of the world. Teradyne says they are winning those specific sockets.
So the strategy is, we might have lost some battles in the past, but we're winning this new homegrown chip market.
Right. And they're also claiming big wins in memory, specifically high bandwidth memory, or HBM. You literally cannot run a modern AI model without HBM, so winning share there is critical.
It's interesting, they're so aggressive on compute and memory, but for mobile, they seem kind of resigned.
Realistic is probably the better word. They expect mobile to get more complex. We're going to see AI models running locally on your phone, which means harder tests.
Sure.
But they aren't betting on a return to the crazy unit volumes of 2021. They know people aren't buying new phones every single year anymore.
So the growth engine has definitively moved from your pocket to the server farm.
100%. No question.
Okay, so putting this all together for everyone listening, we have a massive beat, a huge shift to AI dominance, and a record-breaking start to 2026. But we also have this pretty stark warning about limited visibility later in the year. If I'm looking at this industry, what is the one big takeaway I should be chewing on?
The takeaway is that the AI infrastructure build-out is real. It involves billions of real dollars, but it is becoming incredibly concentrated. We are moving from a world where broad consumer demand drove the market to a world where 5 or 6 giant companies dictate the entire industry's fortune.
And when those 5 or 6 companies decide to take a break,
The entire supply chain feels it instantly.
that leads to my final thought, and it's something I want everyone to consider. Management was very clear that the first half of 2026 is going to be frantic. But if all that spending is front-loaded and we hit July, what happens if that digestion period lasts longer than 3 months?
That is the multi-billion-dollar question. If the hyperscalers buy all their testers by June, install them, and then spend the next 12 months just optimizing software, we could see a very significant air pocket in demand.
So the market is cheering the noise right now.
But I'm not sure everyone is ready for the potential silence that follows.
It's the quiet after the storm that you have to watch out for. A fascinating look at the plumbing of the AI revolution. We will be watching that Q3 guidance very, very closely later this year.
Absolutely.
That's it for this deep dive into Teradyne. Thanks for listening, and we'll catch you on the next one.
Take care.